So how exactly would one go about buying a business with no money? Hi there everyone, it's David Barnett from investlocalbook.com, the blog site and YouTube channel where I talk about buying and selling small businesses, local investing, personal finance, business management, and anything else that people want to ask me questions about. I have been watching for some time now videos on YouTube talking about buying businesses with no money. And I've also gotten several questions over the course of the last year or two from people who want to know how they can put a business deal together to buy a company with no money, or people who've been offered businesses for no money and they want some advice on those. And I thought maybe now is the time to actually create a buy a business with no money video, but mine's going to be a little bit different from all the other ones you can find online, because I'm going to put a little bit of intelligence and common sense into this video. So first of all, what exactly do we mean by buying a business with no money? Does that mean you don't hand over any money on closing day, or does that mean you get the business for free? A lot of businesses are bought with a certain amount of vendor financing, which means that you put part of the money down on closing day, and then the vendor accepts payments over the course of time. Now, it's conceivable, for example, that a vendor may agree to finance 100% of the purchase of a business. I've been involved in a couple of transactions myself where a vendor has actually sold a business and carried 100% financing, but it was usually because there were some specific special circumstances. For example, I once helped a man buy a motel. The vendors agreed to an arrangement which amounted to 100% vendor financing because he was going to use his own cash to renovate the property and then get an appraisal for a higher value, and then he would be able to get a bank loan to pay them out. So it's not that he didn't have any money, he just didn't give any to them on closing day. Okay? He still had cash, he used it to renovate the building. Another example might be someone who has no money in a savings account, but they have other personal assets. So I was involved in another deal where a guy did not take any of his own savings to buy a business. What he did instead was he offered his home as collateral for a loan at the bank. That was the money he used as the down payment. So again, he didn't take any money out of a savings account, but we certainly can't agree that he bought a business with no money, because money did cross the table in that transaction. So I think what a lot of people are thinking of when they think of the question or the idea of buying a business with no money is a flat broke person with no money in the bank, no personal assets that can be offered as collateral, like really no money. And how would this person go about actually purchasing a business that's a going concern? Okay, so let's take a look at that particular scenario. And there are two different ways that we can buy a business. We can buy the shares of a company. We can also buy the assets of a company. There's another video on this channel that talks about asset versus share prices. So if you're not familiar, you might want to go and take a look at that. I'll put a link in the show notes below. So let's think for a minute first about an asset purchase. So in a lot of asset purchases, we have machinery and equipment in the business. We may also have inventory, and there's going to be some money in the bank and some money in the till, in the cash register. So I'm thinking of like a store. So if I'm going to sell you a store and I'm not going to require you to give me any money on closing day, that represents a risk to me, because if I give you the business, you now have all the capital assets, the shelving, the cash register, etc., and you also have that inventory. So what you could do is you could sell off all the inventory, pocket the money, and run away, right? Because you haven't given me any money, you haven't put anything down. I've basically given you control over these assets. You could use them in such a way that I end up getting ripped off, right? So if I was in a jam as a business seller and I wanted to sell a business and I was willing to do vendor financing for 100% of what I sold, what I would technically be doing is not really selling a business. It would be more like liquidating the assets of a business and financing them 100%. Before I were to do that kind of deal, though, what I would likely do is try to liquidate as much as I could for cash to my own benefit to fill my own pockets, right? So in a retail store, what that would mean is selling inventory, maybe having a big sale. So now the normal operating inventory level of the business will be reduced. And in all likelihood, the things that would sell out would be the most in-demand items. So if you think of a grocery store, maybe there's artichoke hearts and canned tomatoes. In my mind anyway, the canned tomatoes would sell out first, right? And you would be taking over a business that had some shelves and some artichoke hearts. What are you going to sell to people? People don't demand artichoke hearts in the same way they demand tomatoes. So as the buyer of this business, even though you got a great deal and you got to buy this business with 100% vendor financing, without some money in your pocket to inject into operating capital to replenish the inventory, you're basically going to be given part of a business, not an entire business, because you're going to lack that operating capital. Another example is if the business, for example, were to sell, goods to other businesses, in all likelihood, that business will have to sell and give people terms, so maybe 30 days to pay. A seller in that scenario is probably going to want to collect all of his receivables. He may pay his payables. If you get that business with no money down, you're going to have to figure out a way for you to cover all the bills for the first 30 or 40 days until your new receivables start to flow back. So again, if you can buy this business with no money down, it doesn't necessarily mean that you don't need any money to buy the business. You're going to have to put in some operating capital. Let's look at a share purchase. So when you get the shares of a company, basically you have all this kind of stuff in the company that's on the balance sheet, which may or may not include operating capital. Let me draw a quick balance sheet on the whiteboard here, and I'll be back in just a second. All right, so now I've created here a very simple balance sheet for an example company. In this company, we have assets, liabilities, and equity over here. I've got cash of $100, receivables of $100, equipment of $100. On the other side, I've got payables of $100, debts of $100, and retained earnings of $100. Now, if I owned this company and I were to say to you, look, I'll sell you the shares of my company and I'll finance 100% of it, what could happen is you could take over control of this company. You could take the cash, collect the receivables, not pay the payables, not pay the bank, pay yourself a bonus of this $200, and then walk away. And in all likelihood, I will have been a personal guarantor on the long-term debts, and the bank will find out a way to come after me. So would it make sense for me to sell a company like this to someone for no money, for 100% vendor financing? Probably not, because I could do my own liquidation. I could take the cash to pay off the payables, collect the receivables to pay off the debts, and walk away and liquidate the equipment, right? So it's very unlikely that somebody who owns a company in this kind of state is going to be willing to sell it to anyone and finance 100% of the transaction. Let me make a quick change. I'll be right back. All right, I made a quick change to my balance sheet here. In this case, what I've done is I've said we still have the same assets, cash, receivables, and equipment of $100 each. But on this side of the balance sheet, on the payables side, I've got $100 in payables, and I've got debts to the bank of $300. Well, if we have $400 worth of liabilities and $300 worth of assets, then what do we have? We actually have owner's equity, which is negative. So technically, this corporation is insolvent. Okay, there is insufficient equity on the balance sheet for this company to exist. Companies can become insolvent for a short period of time, but as long as they come out of it relatively quickly, they can live, to fight another day. But a company that remains insolvent for a long period of time, what eventually is going to happen is that the debts will crush the company. There's obviously not enough profit. There would be losses on the income statement in order for a company to end up in this kind of situation. So this, in fact, though, is the type of company that I could imagine somebody giving away and be willing to finance 100% of the shares, because the shares wouldn't probably actually really be worth anything. So it wouldn't be that big of a deal to finance their sale, as long as you, as the buyer, were willing to assume all personal guarantees on the debts. You see, debt assumption is the same as cash. If I owe the bank $100 and you agree to take over that debt, it's like you just gave me $100 because now I don't have to pay back the bank. And scenarios where there's debt assumption is probably the only kind of situation I can possibly think of where someone would actually be willing to hand someone a company for no money or no money down. The question is, do you want to acquire such a business? Because a business that ends up in an insolvent state is probably a money-losing business. So unless you have a way that's fairly foolproof that you can turn the business around or make money with it, it's probably not something that you want to buy. In a recent email that I had from a potential client, it was a woman who was basically offered a business by her boss who said, I'm leaving, I'm going to move away. If you would like to buy this business, I will finance 100% of it for you. When she asked why he wanted to do it, he said, I want to move to a different place, and this business in this market isn't generating the lifestyle that I require. Big red flag saying that the business doesn't make enough money. Of course he's willing to give it away for free, because in his mind he's already reached the point where he realizes that the business isn't an asset to him, it's a liability to him. It's costing him money to sit and fester, not earning his potential in that particular market. So I hope that that makes sense to people. If you want to buy a business, you should not be trying to figure out how you can take your broke self and connive your way into a transaction where you can buy a great successful profitability with no money down. You're not going to get those kinds of opportunities unless you're talking about someone in your family basically gifting you a business that they want you to basically inherit. If you want to go out and buy a successful business, you have to develop the skills and mindset in your own household that leads to a disciplined budget, that leads to an accumulation of savings. Equity in a purchase situation always starts with having money saved up in a bank somewhere. I even work sometimes with people at a local government economic development agency, and they do very small loans to people trying to start businesses up to $20,000. And their key measurement metric internally within their organization is how much other money they're able to leverage. So to give you an example, an entrepreneur comes in with $10,000, they lend the person $20,000, and now that person can start a company and put that $30,000 on the balance sheet as equity, which then allows them to go to a bank and borrow maybe another $50,000, right? So that economic development agency is able to then say to their board of directors, look, we lent someone 20 grand and they were able to use that to create a company that started off with $80,000 of assets. Does that make sense? Anyway, thanks for the questions. I love getting your questions. Remember that if you enjoyed the content of this video, please give it a thumbs up, like it, share it. It's the only way that the systems that manage the internet have of knowing that the content is actually valuable. And if you want to get videos like this one before anyone else, go to davidcbarnett.com and sign up for my email list. I send out an email every Friday with a new video or story talking about business deals, buying and selling businesses, local investing, etc. And if you're interested in getting your money working for you without actually getting into business, then you'll want to check out my local investing academy. The next semester starts at the end of September, and you can learn more about that at localinvestingcourse.com. As always, if you are serious about buying a business one day and you want to prepare yourself and learn what it is that you need to do, you should be going over to businessbuyeradvantage.com. Thanks, and we'll see you next time. Have a great day.